So I think, often I think about what not to do, because part of as an investor, we're not necessarily looking like 100 things that need to be checked off yes. We're really looking for no reason that we can say no. Because if we find one reason to say no, we're done, right? And so I think more about, the founders. One, it's very important to be organized and have information that's very consistent, because what I see too often is that we start doubting information we get from founders. That's in early days, especially around revenue or ARR. Somebody will send us like an ARR number with some like asterisks, and then you start asking questions and it's not real, and then we're done.
Welcome to the Inside the Fund podcast, where we go to the other side of the table and learn about capital raising from VCs. I'm Helena Fogarty. I'm a fundraising expert who helps startups raise their seed and Series A rounds. And today, I'm speaking with Mark Volchek of Las Olas Venture Capital. Mark is a founding partner of Las Olas VC, which he started in 2016 and is now investing out of its third fund. Prior to starting Las Olas, Mark spent about 15 years at Hire One, a company he founded in 2000 while senior in college. Mark steered the company from its first round of seed funding and multiple rounds of venture funding all the way to a successful IPO in 2010 and beyond. He helped grow Hire One from just 3 founders in a dorm room to profitability, more than $250 million in revenue, and over 1,000 employees. Before starting Las Olas, Mark was an active angel investor with over 30 personal investments. He holds a BA and an MA in economics from Yale. Mark lived the full founder journey, from 3 co-founders to an NYSE IPO before switching sides of the table. Thank you so much for coming in today.
Yeah, thank you for having me.
I reach out to people randomly who I think have an interesting story, and I particularly wanted to have you on here because you really have. You started as a founder. You had the ultimate founder experience going with an IPO. You then you went private and sold? Is that?
Yep. Yes.
Is that
We went public in 2010, and then I left my full-time role in 2014. And then as we decided to go private, and we completed that go private in 2016.
Very cool. So can you tell me a little bit about that? What was that experience like?
Yeah. So, the whole journey, from starting in literally like late 1999, pre-dot-com crash.
I remember that crash.
We incorporated in March of 2000. The crash happened, I think, a month or two later.
Yep,
there was essentially no capital because our original plan was to raise $5 million and go public 3 years later.
Nice.
And neither of that happened. So the first year, we just raised a little bit of angel money to buy servers. Back then, you had to buy physical servers to get started. Then the following year, we raised more angel money to get our prototype out. And then in year 3, we raised our first sort of VC money, a small venture round, and then we raised 2 more venture rounds after that. And then in 2008, so this was 8 years in, we decided to sell a small piece of our company to a private equity firm to create some liquidity for one of our investors whose fund was essentially at its fund life. After 10 years from their fund life. They'd only been in our company for a few years, but they needed liquidity. And so we found a private equity firm to buy them out. And we were able to sell a bit into that transaction as well.
When in 2008 was that?
So that was we closed that a few weeks before the crash in 2008. So we were very lucky that transaction closed with leverage, because it was a leveraged private equity transaction, literally, I think, 2 weeks before the meltdown of the financial system in the fall of 2008.
Well done.
So we were lucky on timing there. And then the private equity firm saw the opportunity for an IPO in 2010. It was a significant, multiple for them for us to go public. And that's what we did in 2010. So we decided to go public. We filed the S1, I think, right around our 10-year sort of company anniversary, so March of 2010, and ultimately completed the IPO in June of 2010.
Yeah.
And really a lot of it, I would say the first 2 months is really just paperwork, drafting, lawyers. And then the whole sales process is compressed into 2 weeks of a roadshow. And we used Goldman to be our lead book runner. And so we essentially traveled mostly US, we traveled a little bit in Europe, and just had one meeting after another, group meetings, one-on-one meetings with lots and lots of institutional investors to essentially get people to buy shares in our IPO.
Yeah.
And then it becomes a crazy kind of last day where everything gets priced, people get allocations, and then the market opens the next morning. And so that was kind of the process. We got to ring the bell on the New York Stock Exchange.
Pretty awesome.
And then interviews on the floor. It's sort of a lot of media and PR. And so that was sort of our IPO in 2010.
How did it go? So I've not checked. I apologize. I did not do my research on this. But I was part of a company that had an IPO. And we were in a 6-month lockup, and the stock tanked. How did yours go?
Yeah, so I would say the pricing process, we came in like at the bottom of our range because 2010 was a tough year.
Yeah.
It seemed like things were good, but at the same time, it was a little softer than people expected. But we got it done, we priced it, and it actually traded up significantly in the first, I don't remember the exact time frame, but it traded up quickly, which to me means we left some money on the table because we kind of underpriced it in the end. But I think that's just institutional investors are much more savvy than the companies, right? We as a company do this once. They buy IPOs every week, which also creates kind of a conflict from the investment bankers who they deal with institutional investors every week. They only deal with us once. So who is really their customer is an interesting question. But overall, the IPO went well. We traded up. I think at our peak, we ended up at about 2x the IPO price.
Cool.
So people who bought an IPO could have exited at 2x probably a year later. I don't remember the exact timeline of the roller coaster. But then the world changed a little bit, and financial services became very regulated. There was a lot of different initiatives from Congress, from the regulatory agencies, which really put pressure on all of this sort of new sort of financial or fintech companies like ours. And that's really what precipitated us to decide to go private again. We didn't think being public at $1 billion market cap was really a good idea anymore. Today, I think most people advise companies to be at least 4 or 5 billion market cap before thinking of going public because of the cost of being public. And it's not just the hard cost of lawyers and accounting. And, that's not the end of the D&O insurance. There's a lot of hard costs, but that's one piece. It's more the internal cost, the distraction, the focus on quarterly results. You can't tell your employees all the information that you would like to because otherwise they become all insiders if they have inside information. And so it creates a lot of interesting sort of struggles internally and inefficiencies. And as CEO, I felt like, 4 years later in 2014, when I decided to leave my full-time role as CEO, I just wasn't having as much fun anymore. I was spending a lot of time with our public investors, with activist investors, with regulators. I would say at least 2/3 of my time was on inefficient things that I didn't really want to deal with. And so at that point, we decided the best outcome for shareholders was going to be to go private. And I didn't want to do that transaction anymore. I was kind of burned out. I'd been 15 years. And so I left my full-time role and we brought in an interim CEO to just do the transaction, who was more of an investment banker kind of person. And we got it done in 2016. And essentially what we did is we split the company into 3 parts. We sold off 2 of our divisions, and then the last part went private and got bought by Blackboard.
Nice. And can you tell me why you started Hire One?
Yeah, so dialing all the way back to 1999, I was a senior in college, and my 2 co-founders were also students. One was a junior, one was a sophomore, actually. And we saw a problem that all sort of administrative things at the university were paper-based. So paper bills, you got to send a paper bill for your tuition. Financial aid was all paper. Would take weeks for you to sign the papers, get them back. Then eventually you got a paper check you had to take to the bank. Very inefficient. And so late 90s, there were electronic transactions being used by other industries, but not in higher education. So we said, let's bring modern, back then that was ACH and credit card payments, to higher education. And then we were able to integrate sort of a debit card into people's ID cards. So you could use one piece of plastic to sort of open your dorm, but also to, buy food or go to the grocery store.
Yeah, that's cool. And what were some of the tough times that you remember running the company?
Yeah, so, fundraising is always tricky.
Before we go there, I want to say, so fundraising versus the roadshow for going public. How did those meetings differ?
Yeah, so I think the big difference going public is that Goldman set up all the meetings for us. So there I felt like I was more of an actor. I would show up to a meeting, I would do the 15-minute pitch, I would answer questions, and then go to the next meeting. And it was sort of like, I didn't even know who these people really were. I didn't know what their hot buttons were. It was more a very transactional, kind of like 30 minutes in and out, and just coached by sort of a large investment bank who knew those folks. And it was kind of like an inside baseball where I was kind of the outsider.
Yeah.
Raising capital kind of on angel investors or venture capital is more of a relationship process and takes months, and you get to know people, but you have to kind of figure out who to target. Then you have to figure out how to get a meeting. Then you have to figure out how to do a good job in the meeting.
Yeah.
Then the follow-up. So there's a lot of steps. So fundraising sort of as a company, sort of in the earlier stages of the company, are really kind of like a process. And you really got to think through, and no one's helping you. So you really are there to do everything from, identification, so like finding the right people, to closing the deal.
Yeah.
And so it's very different.
I appreciate that perspective because I have never done the roadshow for an IPO. That's incredible. Before we walked in here, we were talking about how startups can go differently and how now you're an investor and you know that many companies go under. You had the ultimate upside kind of outcome of your company. But can you tell us, were there tough times during the way there?
Yeah, that's why I was going to jump on that question around sort of fundraising and running out of capital. So, we were sort of in a spot where after the dot-com crash, it was really hard to raise capital.
Yeah.
And starting a tech business back then was more capital intensive than it is today because there was no cloud, there was no AI. You need a lot of people and servers. And so we essentially raised just enough money every time to run for 12 months, which means by the time we raised money again, we were essentially out of money. So I think 3 times during kind of the early journey, we had less than 2 weeks of money in the bank.
Yeah.
We could barely make one more payroll.
Yeah.
And we even let people know that we'd have to lay them off if we didn't raise capital because we really wanted everybody to be on board and know what was going on.
Yeah.
But those were hard, right? You had to tell all your employees, we may or may not be able to pay your next paycheck.
Yeah.
Here's where we are.
I was at a startup and I was kind of the deputy to one of the founders. And April 2020 or 2000 was really rough. I think it might have been April 20th of 2000. And there were articles in the New York Times about dot-commers and tech people and how terrible they were. Like it went out of fashion very quickly. So I can't imagine what it was like to raise money during that period of time.
Yep, definitely difficult.
Yeah, the company I was with was unable to. And we ended up shutting down in 2001, I think, early 2001. So again, different outcomes, very common.
Right.
During that time.
Yeah.
Yeah, but you pulled it out. And so when you went public, was that like the best day of your life at that point, or what did that feel like?
I mean, it's clearly a very exciting day.
Yeah.
But I think you very quickly figure out that it's really not an exit.
Yeah.
It's really just a transition to the next step. You're going from running a private company to a public company.
Yeah.
There's generally not a lot of liquidity for investors or for founders. We were able to sell a little bit into the IPO because we didn't need a lot of capital. The company was very profitable. And so really most of the IPO was secondary shares being sold by some of our investors, by the founders. But we didn't really like the IPO price. We felt like we were being, lowballed on the price, which turned out to be right. And so we only sold a little bit into the IPO. And then we set up these non-discretionary trading plans that you can do at the time of the IPO where there's no non-public information that gives you a safe harbor. And you can have those be formulaic. So based on the price of the shares, you can sell more or less every month on a special date. And so that's how we ended up selling stuff over the next 3-4 years. We were able to sell more shares through those plans and then ultimately sold everything else we had at the go private.
Yeah. So it was a nice outcome, but it wasn't an immediate
Right. It was a
going to the
5-year
bank with
journey.
$1 billion
Exactly.
outcome.
Yep.
Yeah. That's exciting though. And you started angel investing in 2008.
Yep.
Which again is a funny time to start, but tell me about that. How did you get started?
Yeah, so I mean, we got our first liquidity out of that private equity transaction. We did it in 2008. And so, we were trying to figure out what do we do with this capital now? We'd never really had any money or made any real money before because for the first 8 years, we were making very small salaries. We had no liquidity. And so one of the things, we got a lot of founders coming to us, ask us to invest in their companies, which we couldn't do before '08. But starting in '08, we started saying yes to some of those folks. And I would say the initial investments were really more, felt like giving back to the community. They weren't really like making investments in a smart way that we would make money off of. And when you look back, I think those beginning was really a learning experience more than a good investment. Most of those companies went under pretty quick. We invested in things that really were too early, we knew nothing about. But what we learned over those early years was that the outcomes were much better when we were either involved in the companies or we knew something about what we were investing in and could write a bigger check. We would pool it between, the 3 or 4 of us. And that was much more rewarding financially, but also more interesting for us if one of us was on the board or an advisor. And that sort of professionalized kind of our angel investing in the sense that we would only invest in things where one of us would sort of take a lead and be involved with the company in some way, which was kind of the first step in sort of professionalizing kind of random angel investing, small checks, to something a little bit more structured and which made a little more sense.
So you're saying are you working with some of the same people you were working with at Hire One, or did you work with other partners?
Yes, it was actually 3 other folks at Hire One, the 4 of us, my 2 co-founders and Dean, who was a CEO we brought into our company. So in 2002, we decided to bring in Dean as a CEO because we were all in our early 20s. We felt like we needed something with a little more experience, exactly. And we didn't want the VCs to come in and hire somebody for us, so we decided to hire our own CEO.
Yeah.
And so I was CEO of the company for the first 2 years, and then brought in Dean from 2002 to 2011. He left about a year after the IPO, and then I became the CEO of the public company again. And in the meantime, I was CFO and chairman of the company, which was a weird combination. Yep. And Miles, my co-founder, was COO. But basically, we did all the angel investing between the 3 founders and Dean, because all 4 of us had gotten that liquidity at the same time in 2008, and we were sort of trying to use the collective knowledge, not just for angel investing, but also for investing the rest of our balance sheet. Yeah. So we were pooling our money and making sort of investments all across sort of the asset classes as a group, which gave us some buying power and a little bit more sort of thought process between 4 of us instead of doing it by yourself.
Yeah, but it also indicates that you like each other. You want to keep working together.
Yep, exactly. And now, I started the fund with Dean in 2016. So now I've been working with Dean since 2002. So it's been 24 years.
Yeah, I was interviewing another founder who had a huge exit and then has become an investor. And he has been working with the same 4 guys since they started. And when they had their big exit, they all went on vacation together for a year. I was like, wow, that's a strong relationship. That's really, really amazing.
Yeah, we actually so we started doing on the first year anniversary of incorporation, we all went for dinner together.
Yeah.
And then the dinners became weekend trips, on the anniversary. And then for the 10-year before the IPO, we all went to Rome together for 4 or 5 days. And we still do those trips 25 years later. So we just did Mexico City together. And it's a little broader than just the 4. So we invited some of the senior folks on the team as well. So we have 6 to 8 people who go on those trips. Still now, 25 years later, 10 years after we've exited, all left the company. So
pretty cool.
It is important to work with people you like working with.
Yes.
And that's a good fit. So I think that was sort of an important part of it.
Yeah.
Because if you're not happy doing what you're doing, it's really hard to do a good job.
Yeah. So I'd like to take us into what you're doing now. And I think that your experience with the IPO and then going private has informed your investing quite a bit.
Absolutely.
So tell me about what you're doing with Las Olas and how the ultimate outcome that you optimize for with your investments.
Yeah, so we really started Las Olas VC in 2016 as sort of an outgrowth of kind of our angel investing. So Dean and I, we're getting back together and saying, what are we going to do next? We had both taken some time off since leaving Hire One, and we were sort of trying to figure out, do we do another startup? Neither of us had a great idea. And we said, well, why don't we just support, founders and sort of do more of the portfolio approach? And we were sort of debating how to professionalize our angel investing. And as we started talking to advisors and people in the VC industry and lawyers, everybody said, well, if you're really going to invest on behalf of others, doing angel groups and other things is very difficult because not having discretion, you can't move as fast as you might like.
Right.
And so we said, well, why don't we do a real fund then? And this way we can, make commitments, make investments, lead rounds, take board seats, which has been very successful for us on the angel side. And that's kind of what we did with Las Olas. So we said, why don't we invest in what we know? So bringing modern tech to antiquated industries. So that could be logistics, that could be government, that could be, manufacturing. So we have stuff all across the different industries, but it's essentially, the early days it was, web-based software, then it became mobile, then it became SaaS, now it's AI, but it's essentially the same concept of bringing this modern technology to companies that wouldn't do it themselves. And that's really what we started doing. So initially the fund was really just our own money and some friends and family and other folks. We got into that first close. And then we started expanding sort of the breadth to some of the folks we had met in Florida that were looking to invest in technology, but it really made their money in real estate or made their money in some other industries and knew nothing about tech, but they wanted to sort of take advantage of the opportunities there. And so we got some capital there, and that really is what formed Fund One. And we wanted to see how it would go, and it's been a great experience. And our goal is really just to create good returns for our investors while kind of also contributing to the tech ecosystem, building a great reputation, helping founders, and kind of, in the end, making the world a better place.
Yeah.
But the first criteria is really to create good returns for our investors.
That's your fiduciary duty.
Exactly.
Yeah, you're bound. So what time, how would you break up your time during a normal week? What amount of time is working with the companies, sourcing new deals, communicating with your LPs?
Yeah, so I think it really depends on where we are in the fundraising cycle and the fund cycle. And we've sort of, I would say in the early days, we were kind of all doing everything, and we didn't have a lot of portfolio because when you just start, you're really more focused on raising the first fund, making the first few investments. Now, 10 years in, we have a lot of companies. We each sit on, I think about 10 boards approximately each.
That's a lot.
So it's it shifted a little bit. And I think I've sort of taken a little bit more of the lead on some of the fundraising, and this has been last year and this year have been very focused on fundraising for Fund 3 for me. But at the same time, Dean's been focused on some of the portfolio companies and doing some transactions, supporting them with that. So I think we've become better at splitting the opportunities. But for me, I really like working with the portfolio companies. And so I try to spend as much time as I can with the portfolio companies, especially the ones that I'm on the board of. And then fundraising for Fund 3, which we're about to finish up and close out.
It's amazing.
And then, I feel like over the last 10 years, I do less and less sort of sourcing or first calls. So I am involved in, once we get kind of past the first sort of call and we really like something, but we've been able to delegate to more of our team now as we've sort of built a team and there's more folks around us.
Yeah, that makes sense. I mean, before we started the cameras, I was talking about how you must be dealing with a lot of pitches, but also a lot of hope and dreams. And you've got to navigate that as someone who's doling out the cash.
Yep. Yeah, I mean, we look at thousands of opportunities a year to make maybe 4 or 5.
Yeah.
So there's a lot of whittling down. And primarily, we focus on finding companies. So the first cut is finding companies that meet our criteria.
Right.
Are they the right stage? Are they, the right amount of traction? Are they raising the right amount of money, that fits in our thesis?
Yeah,
And
so tell me about that.
yeah, so some of it is just, mathematical. So we're targeting sort of initial checks of, call it approximately $2 million, right? In rounds of 3 to 5.
Yeah.
So if someone's raising $1 million, that's probably too early for us and not a fit. If someone's raising $10 million, it's not a fit.
Yeah.
So, we have a thesis that we want to own, call it 10 to 15% of the company for that kind of $1.5 to $2.5 million. So that kind of gives you a bracket around how much the company needs to be raising and what valuation. Right, so our post-money valuations are generally between 10 and 20 million, which will imply traction of maybe a few $100,000 of revenue to $1 million. So if someone's doing $3 million of revenue, they probably want the higher valuation, or there's something wrong with their business. And so we try to, because we need to look through thousands of companies, we try to find a quick sort of way to categorize companies that either fit our criteria or don't. The same thing geographically. We're drawn more to companies that are on the East Coast of the U.S. just for practical reasons. We like having in-person board meetings. I come to New York very often. It's not practical us to do exactly.
Yeah.
It just came from Boston. California, we try to stay away from because we feel like there's negative selection. If you're based in Silicon Valley, why are you calling me in Florida?
Yeah.
Right? So those are some of the things we think through to sort of go from a few thousand opportunities to a few hundred opportunities.
So is the middle of the country out?
No, we like the middle of the country actually, but it's more difficult to spend time there because there's not enough concentration.
Yeah.
So in terms of, we have in Fund 3, one of our companies is in Nashville, one of our companies is in Salt Lake actually.
Yeah.
Well,
Utah is a huge entrepreneurship hub.
Exactly.
Yeah.
And there's not a lot of capital. So part of it is we're looking for things where, we can add real value. We're not sort of the third choice for founders, but we're first choice because we got an introduction to a place that's not saturated with capital.
Yeah.
And so we like some of those, but it's much harder to find those opportunities because it's not as dense. I can come to New York and go to events and spend 3 days and meet hundreds of entrepreneurs. I can't do that in Nashville or Salt Lake as easily. I mean, there are events, and we try to participate in those regional and statewide events. New Orleans has a great annual event, and Nashville has one. And so we try to do those, but it's obviously not the same scale and density as New York City or Boston would have.
Yeah, absolutely. And talk to me about your range of outcomes that you're shooting for, because I talk to a lot of investors who want the power law, who want the 100x outcome. Something that intrigued me about you is that you've seen it all. And from our conversation, it seems to be a little bit more founder friendly in terms of the, the range there.
Yeah. So, part of what we've always been thinking about is how can we sort of replicate sort of a great return we had in Fund 1 to Fund 2 and Fund 3. And we always believe that chasing one unicorn per fund is really hard to do because how do you know up front that you're going to have one unicorn and everything else will go to zero? That didn't seem to make a lot of sense to us. Yeah. That said, power law is still very important. So even in our Fund 1, where we feel like we have a wider spread of outcomes, most of the fund returns will come from 2 or 3 of the 15 companies in Fund 1, and then maybe another 2 or 3 that contribute something meaningful, but not 100x. And then there'll be a few more where maybe we get our money back or 2 or 3 times our money. And there's probably will be somewhere between a third, around a third, call it, that we'll probably lose money on. So somewhere between 0 and 1. Right. Which is still a lot less than I think most funds. And I think part of that is that we don't necessarily push founders to run off the cliff. So once we identify that a company may not be on track to sort of be a venture scale return. So we think of a venture scale return of at least 10 or 20x. Yeah. But if we're, a few years in and the company is not growing as fast as everybody would like, we don't push the founder to just, put everything on the table and run off the cliff. But instead, we help them maybe find a soft landing. Maybe they can find a way to exit the company and at least get some money back to investors. And it creates a better outcome for the founders and for us. And I think just, reputationally, I feel like one of the most important things in venture capital is reputation, because every fund has capital, but it's the reputation and how you support founders, the advice you give them. And so we really try to be, as founder friendly as possible, because that's what gets us the next, founder that may be the big success story. And so we really need to do that, I think, because if you get a bad reputation, you still will be able to do deals, because there's always somebody who wants your money. But the best founders and the best opportunities may not, want your capital. And so that's where we really think about that negative selection problem. How do we find the best deals and get into those best deals? Right. And so I think one of the questions I often get from folks is, why do we want to be lead investors? Why don't we just, do follow-on checks? It's a lot less work. And you could do a lot more investments and try to find that power law by making 50 passive investments and hope you hit a unicorn. Yeah. My view on that is, if you make lots of small investments, even if you have a big outcome, it may not be enough to drive your fund. And my belief is you get negative selection, and the fact that the best opportunities end up being oversubscribed, and the lead investors never get pushed out, but the follow-on checks are the ones that get pushed out. And so my view is to get into those best opportunities requires being a lead investor, adding value, being on the board, being a trusted partner to the founders, not just sending a check and then, pushing them to make 100x or 0. I just don't think that's the right model.
Right. And how often do you talk to your founding teams?
That really depends on the company, the stage, the personalities. I have some founders who text me, every week or two with
Yeah.
some question or asking me something. Others, maybe every few weeks or once a month. And it also just depends how far along they are. So once they've raised maybe an A round and then a B round, we take less of an active role because some of the later stage investors have a lot more resources. They might have 2 associates and a partner assigned to a board versus, I'm on 10 boards. So I have to sort of allocate my time to those companies where I can make the biggest impact.
Yeah. So when you meet a founder that fits your thesis, that's exciting. Is there something that they can do to get you more excited? Like, are there any tips you can give?
Yeah, so I think, often I think about what not to do,
Yeah.
because interestingly,
give me that.
because part of as an investor, we're not necessarily looking like 100 things that need to be checked off. Yes,
Yeah.
we're really looking for no reason that we can say no.
Yeah.
Because if we find one reason to say no, we're done.
Yeah.
Right. And so I think more about, the founders. One, it's very important to be organized and have information that's very consistent because what I see too often is that we start doubting like information we get from founders. That's in early days, like especially around revenue or ARR, like somebody will send us like an ARR number.
Yep.
With some like asterisks. And then you start asking questions and it's not real. And then we're done, right?
Yeah.
So it's one misstep
Yeah.
is really important. So what we focus on when we sort of, once they get past that first role is like, what's the traction? And I think that's where a lot of founders kind of mess up is, they don't tell us like the real traction they have and how they're going to get to sort of that next milestone. Because in the end, we're evaluating the team. So the way I would sort of position it is, there's really kind of like 3 main areas that we think makes companies successful. The first is the team, and I'll come back to that in a second. The second is the TAM. How big is the market?
Yeah.
How much revenue potential is there? And that's a really tough question as well. And we really want the founder to have a very strong view on, what is the potential revenue opportunity? And if people come back and say, well, the total spend in industrial, manufacturing is so many trillion, that's not an interesting number for us.
1% of that.
Yeah. We want to know if I sell my software to every factory that does X,
Yeah.
which is what your software helps, then this is how much revenue 100% of that market would be. Like a more thoughtful approach. And we need to see a market of at least 1 or 2 billion, ideally a few billion.
Yeah.
We don't really want to see a market of trillions because that's sort of amorphous and it doesn't tell us what you're actually going to do in terms of your ICP and where you're heading. So that's kind of the market. And then we really want to see products that solve a real problem that have an IRR. So things that people are really going to buy, even in tough times. If it's creating an IRR and saving the company money or something they need to run their business, like compliance or quality assurance or something that the company needs, then they're more likely to buy. Because we've invested in things that were cool and it seemed like there was some traction, but it was more of a vitamin and not a painkiller. And so that's sort of the third part. But going back to team, often it's difficult to evaluate the team. So what we then really focus on is what has the team accomplished with the resources they've had so far. So if they've raised $1 million, what did they do with that $1 million? How much traction, how much revenue, how much pipeline? And that's all part of the evaluation. But it's also, what is the interaction? Like, how did they reach out to us? How thoughtful was that? Did they just send us a cold email? What was in the email? How well do they respond to questions? So after a first call, if we like it, we always send a list of sort of follow-up questions and see what we get back, how quick. If it takes a week or two for somebody to respond, that's probably already a reason to say no. We want folks who can move quickly, right? And our most successful companies are, pushing features every week. That, in the old days, you would do a release every few months or once a year. Now it's by the week. And so we want founders who understand you got to move quick. You have to, adjust. And if you're asking for capital, you got to be on top of that and you got to have good answers. You got to be prepared. And you got to be willing to, if it takes all night, work on the answers and send them the next day. And I think that's sort of all part of that evaluation and how teams work together, who's responding, even on the calls, on Zoom. We try to meet we actually do meet all teams in person before we invest.
Wow.
But the earlier, the better.
Yeah.
Because we want to see how they interact with each other, with us, maybe a potential customer. We will try to like set them up with a potential customer intro and have them be on the call with them and see how that goes. Like all that's part of like evaluating the team. And I think that's the most important thing we've seen is teams who can, execute and succeed and get things done are the ones who win. And teams that, are sort of studying things and making plans and don't get anything done, obviously doesn't go anywhere.
Yeah, and the old asterisk on the revenue. I want to go back to that
Yeah.
because you do B2B SaaS.
Yep.
And so how often are you teaching people that, MRR, ARR is the recurring revenue, not any service, not any one-time service fees? Like how often do you have to teach people how to actually create the right revenue number for you?
Yeah, so by the time we invest, so we're really generally not the first investors. So we're, I would say, the first like fund maybe investing, like
Right.
the seed stage. Most companies have already raised some pre-seed money, have some traction, some customers. We expect them to know that.
Yeah.
So in my view, if founders don't know, they should have educated themselves and gotten some advisors. They should be doing that at least some way they think is correct. Doesn't have to be perfect.
Right.
But, for us, it's important. And the advice I give to founders is not to try to just create one metric. If you have sort of like signed revenue of 1 million and 500,000 of it is implemented,
Yeah.
just put that on a slide.
Yeah.
1 million signed,
Yeah.
500,000 live and paying. Like we want to just know all the information.
Right.
But that's important for us because sometimes we only see CAR, and in my mind is like, well, is any of it live?
Right.
And if I have to ask that question, you're just like creating doubt in my mind.
Yeah.
Versus if you have 500,000 live, put that on the slide.
Yeah.
And if you have a pipeline of 5 million, put that on the slide.
Yeah.
Put as much information because we're eventually going to ask you for it, and hiding it isn't going to help. Anything that shows traction, put on the slide. Is what and even if you have service revenue, put that as a separate line. Just
Right.
put all the
But that's thing,
information on
it's a
there.
separate line. It's not lumped in.
Exactly.
Different. It adds it applies to valuation very differently, if it even applies.
Exactly.
So how many deals do you do a year?
We do 4 or 5 generally. 3 to 5. It just depends on the year.
Nice. So you look at thousands of deals. You make 4, 5 decisions. And how do you manage the incoming pitches?
Yeah. So, in one point, like, let's just use, 3,500 as a number, right? Seems like a big number. But if you divide that by number of days, that's why I picked 3,500, it's really 10 a day, which is actually much more manageable because we have a team of called, was it 5 on the investment team now. So it's only 2 per person per day.
Yeah.
And that's not really how it plays out. But if you think about the number, it's actually not that big a number, right? 2 per calendar day per person. And the reality is we get a lot of cold inbounds from referral sources, from people. I get a lot of inbound. Our team does. And I try to screen anything I get, for example, I screen. If I think it's interesting, I send it to one of our folks on the team to take a first call or to study the deck or, take the next step. And we log all that into our CRM that we use. And we just have a process, right? So we go from reviewing the deck. If we like it, then we take a first call. Then whoever took the first call will present that to our sort of weekly meeting that we do every Tuesday. If, one of the partners is, convinced enough, then we do what we call a partner call, which would be the same person who took the first call with one of the partners will take a second call. If that goes really well, then whoever took that call will pitch it to the full meeting again and say, should we take a full team call? That'll be the next step. And then after that, we just really go into diligence. And we try to go from sort of first call to term sheet within 2 to 4 weeks.
It's fast.
We try to be very fast. Doesn't always happen that way. It sort of depends on where we are. We work on a different deal. It's a lot of different factors. But if an investment opportunity is time sensitive, so a company might be pretty far along, we think it's a really hot opportunity, might already have a term sheet. We've moved as fast as 7 to 10 days from first call to term sheet.
Yeah.
We don't like doing that because we feel like we're not doing enough diligence and there's more risk of us ultimately not being able to close. But we've only had in the 10 years of operating, I think we've only maybe not closed on 2 or 3 opportunities that we had a term sheet out and ultimately failed in diligence.
Yeah.
But that's, we close on over 90% of what we
it's amazing.
on their term sheet.
What do founders do now that drives you crazy?
You mean the pitching or the founders
pitching.
that we've already invested in? Oh,
Yeah.
as part of the fundraising process. Yeah, so I think that, to me, the responsiveness is the easy, feels like the self-inflicted mistake that I keep preaching about. Someone will reach out to us and we'll respond and say, oh, we'd love to have a first call. And then it takes them a week to respond.
Oh, yeah.
Or we set up a first call and then it takes them a week to follow up.
Mm-hmm.
Or another pet peeve is somebody reaches out to me with a very good, intro email, or maybe they even got a warm intro to me with a great, intro email and saying, can I send you my deck? And then I'll respond saying, sure. And then say, I'll get it to you in 2 weeks because it's not ready. And I'm like, don't do intros if you don't have the asking to send the deck if the deck's not ready. Right. So what we advise our founders, so kind of just flip that around, because we obviously advise our founders on the Series A and Series B rounds, is do a lot of prep.
Yeah.
So spend
Get
a month,
ready.
2 months,
Yes.
be 100% ready and run a very clean process.
Yeah.
Build a list, 100 prospect VC funds that are really on target.
Yep.
Don't email VC funds that invest in, industrial hardware if you're doing software, right? Find the right funds, the right stage, the right industry. Find the 100 top funds for what you need, and then create a timeline of I'm going to do first calls with all these 100 funds in this 2-week period.
Yep.
So you start reaching out to them 2 weeks before saying, I'm going to take calls, starting January 15th. Can I schedule you? And really create a process like an investment banker would do. So create, 2-week window for first calls. Say you're going to open your data room on February 1st, and then you kind of, have a process from there.
Yeah.
Rather than kind of haphazard get lots of intros, because then you also have people on different tracks.
Yeah.
I may already been studying this for 4 weeks, you're doing a first call somewhere else, and you're going to create a bad situation for yourself, and the investors will be frustrated.
Yeah, no, that's exactly what I tell people to do. That's what we work together on. But, it feels uncomfortable to a lot of people, especially when they're worried about running out of money, to control the process and to delay things in order to get everyone at the table at the same time.
Right.
Yeah. What do you wish founders understood about VCs that they don't?
Yeah, so one of the things that I've been starting to talk about more, and I wish I understood better as a founder, is sort of, and this will be a weird point, is VCs really focus on portfolio construction. And often, I think other VCs actually don't even think about it this way.
Yeah.
But portfolio construction is really the concept of how many investments am I going to make, at what size of my fund in terms of first checks, follow-on checks, and how many of those do I expect to be sort of zeros versus wins, kind of what we talked about a little bit earlier. Because that sort of construction informs what type of fund you're dealing with. So if you think about sort of the extreme sort of Silicon Valley type fund that makes 30 investments and hopes to have 1 or 2 winners, and everybody else is a zero, that's a type of portfolio construction. We're going to make 30 bets and get 100x here and all zeros everywhere else. And then the other extreme will be sort of a private equity type fund, which exists at every size. There's private equity type funds that write $2-3 million checks and ones that write hundreds of millions of dollars per check. But those might have 15 investments and no zeros. So they expect every investment to return between 1 and 3x.
Yeah.
And that's a very different portfolio construction. And follow-on investments, how much money do people reserve for follow-on? It might be an important thing. And so there's no right or wrong portfolio construction. But from a founder perspective, it's important to match what you want to accomplish to what the fund is trying to do. So if the fund has a no-zero sort of portfolio construction, then you're going to have a much less sort of risky sort of path forward. You're not going to be able to burn a lot of money and try to become a unicorn. So if you as a founder want to target an IPO at all costs, don't raise money from somebody who's trying to get us 1 to 3x on every transaction. Right. On the flip side, if you're a little bit more conservative and don't want to do all or nothing like the Silicon Valley style, then our fund, for example, we're happy with a 10 or 20x. We'll support folks with a 3x, and we'll help people get out at 1x if that's what it takes. But it's sort of in between, right? And so it's important to understand that as a founder, what you're signing up for. Are you signing up for 100x or failure? 1 in 100.
Right.
is that really what you want? And so I think that's an important piece that I feel like founders should appreciate and know more. And actually, we encourage our founders now when they raise the A and B round to ask that question, particularly in the B round.
Right.
There's a lot of growth investors that are sort of camouflaging as venture capital.
Yeah.
And those may or may not be the right funds if you're a really aggressive founder and want to be able to run big losses and burn, and then raise a C round and a D round. That may not be the right fit. On the flip side, if you're a more conservative founder and you want to, you've gotten already 10x for your early investors, and now you want to kind of lock it in and build a, $500 million company and exit with a partner that will help you get there with a lot of capital, but they don't want a lot of risk. That may be a good partner for some people, but understanding that is important. So we tell our founders, ask them about their portfolio construction.
Right.
How many zeros did they have in their last fund? And that'll tell you a lot about what kind of investor they are.
Yeah. I have a question for you, and we didn't cover this before, so we can always cut it out if I don't either say it right or you don't want to answer. But as an earlier stage investor, how involved or how important is it for your companies to get the next round, and how involved do you guys get? I mean, warm intro, sure, but like you're betting on them, most of these people being able to raise another round.
That's right.
So are you involved in that at all, or like how does that work?
Yeah, we're very involved, particularly being on the board. Obviously, we have to be involved, but we also like really help the founders create a playbook similar to what we just talked about around, coming up with those 100 names. We won't necessarily help them come up with it, but we'll guide them to, today with AI, it's pretty easy to research on funds and categorize them. And we do know a lot of funds that we've co-invested in the past that we can get to. But sometimes there's industries where we don't know the investors, but still with AI, you can make a list and we help them with the process. But we also get on calls with, especially in the later stage rounds, they all want to talk to the previous lead investor.
Yeah.
So that's an important part of their valuation is, who's the lead investor before? Why do they like it?
Yeah.
I'm part of that sales process, particularly in the hotter, bigger rounds. And I would say, the industry, we see these weird industry reports that graduation rates from seed to A are only like 10%, 20%. I'm not sure what data that's based on, but for us, it's a lot higher. I would say, probably half, if not more, of our companies raise sort of an A round.
Yeah.
And then there's another category of people who raise kind of like a bridge to profitability round or some other intermediate financing. But we reserve significant follow-ons to support the companies and to sort of double down on the winners, but also to be able to support some companies on the defensive posture. Not that we want to put a lot more money into companies that aren't going to be, big success stories, but we do want to support the founders and help them get to a stable place, which may or may not be, a 100x outcome, but it's still, we want to support them and get them somewhere where they can have a good outcome for themselves and we can have a decent outcome for the fund.
Yeah, I imagine that's part of the evaluation of the founding team at the start.
Absolutely.
Like, sure, you've got us. We're ready to invest. Not saying that to them, but in your head, but are they going to be able to raise the next round?
Right. And we do think a lot about how well do they do on pitches? How do we think? And that's why the TAM is important.
Yeah.
It's not necessarily important for our round because if the TAM is $1 billion and we want them to get to 5 million ARR, the TAM's not going to be an issue. The TAM is really an issue being able to raise the next round because the growth investors might want $1 billion or $2 billion TAM. And to eventually become a 100 million ARR company, you do need a TAM of $1 billion plus, unless you're going to have a huge market share, which is possible. We have some companies that we think that operate in narrower verticals and have no real competition that maybe they can get to 20, 30% market share.
Wow.
But still, if you have a small TAM, there's a lot less room for error. So we really focus on companies that, have addressable markets of, billions.
Yeah. As a former founder, I shouldn't say former. What do you wish other VCs understood about the founding teams?
Yeah, so I think, it's interesting. Most VCs and most of my fellow board members on these companies are not operators.
Yeah.
And so often, the thing that I wish they'd sort of focused on more is sort of the team dynamics, like hiring, letting people go. I feel like it's too easy to sit in the boardroom and say, oh, let's eliminate these 5 people and 10% here. Let's add 3 people here. It's not an Excel spreadsheet.
Yeah.
Like these are people, they're people you work with. It's not that easy to just let people go because you decided to change something, or hire 5 new people. It's not so easy either. You gotta find them, you gotta train them. So there's a lot of people dynamics that I feel like non-operators miss. And even in my own company, I remember being, actually post being CEO, I was still on the board till we went private in 2016. So for that 2-year period. And I would go to board meetings and some of the board members would say, oh, let's just do this and tell them to do that. And I'm like, I don't think that's going to work. And like, how do you know? I said, I've worked with these people for 15 years. These are people, right? If you just change direction, they don't believe in it. They're going to leave.
Yeah.
Like people who are very successful, your A players have many options. So the key is you have to have buy-in. And so that management of people, I think, is some things like some investors are too focused on Excel spreadsheets and not enough about real life, like how do you build a team? How do you make sales? How do you sort of build a culture? Because in the end, just like a venture fund, most companies are just people. It's a team that can execute. And if you lose the team, you might have no company.
Yeah. But I think you have an incredible perspective on that. And also empathy.
Yeah, and I think we also sell that as part of our process. So I think that helps us get into some very competitive deals and push out sometimes other investors who might even offer better valuation or might have a better on paper, like a bigger fund. But founders, I think, are starting to understand that they really want to partner with investors who've done it before, who have an operator perspective, and can help when things get tough, either in terms of team building or culture building or sales or whatever. Building a company requires lots and lots of skills.
Yeah, because there's this idea that, you go and, founders go and pitch VCs who have never done it. They get investment from VCs who have never done it, and they get told what to do from VCs who've never done it. That's not the situation with you.
Exactly. And we highlight that, early on. And we think that helps us actually create a better outcome. It helps us pick better companies. It helps us give better advice, get into better opportunities. I think being operators, and there are more and more venture funds that are run and started by operators.
Yes.
But it's still a minority of funds, and it's usually the smaller, earlier stage funds. The later stage funds seem to be mostly run by financial professionals.
Does that empathy get you in trouble ever?
I don't know, in trouble. I think we are probably sometimes a little too soft on management teams. But I don't know that that's trouble. Sometimes, like, pushing too hard is not the right answer. So I do sort of step back and often think about it. But I feel like being aligned with the founders is the only winning proposition. Trying to fight founders or fight with the management team, even if you're right, gets you nowhere. And so my approach is, like, how do I get the founders on board with whatever I think the right path is? But trying to sort of do it by brute force doesn't really work. Even in the few situations where we've kind of had to sort of bring in maybe a new CEO, it's much easier for me to say, because at Hire One we brought in Dean as CEO, and now he's my business partner at the venture fund, 25 years later. So it's easy for me to say, sometimes you got to bring in somebody with a little bit more experience. And we've had a few of those. And I'd say, half the time it works out successfully, but we always make it sort of like we work with the founders. We try to figure out for them to bring in somebody. And the one situation I think that's worked out pretty well, the founder brought in one of his sales advisors that he knew as the CEO, and it's been pretty good. In another case, the founder brought in somebody who was the wrong person and ended up not working out. And, in one case, we had a situation where the 2 founders didn't get along. That's a lot trickier. But even there, we ultimately try to work with both founders and try to find a path that's acceptable to both. And in that case, that's also worked out well. We ended up being able to, the founders did separate. One of them stayed, one left. But we were able to make that work for everybody.
I mean, I think there's ways to resolve these sort of things where people end up better off. But there's the ego hit.
Right.
That's I think when people are really tied and fixed to that, that's when, they're hurt, they're upset, they're unable to say, hey, I'm much happier at this point not being CEO than I was before.
Yeah, we try to test that. I mean, I often, when we're out for, lunch or dinner with the founding team during the diligence process, I'll often ask them, if you had to, if you felt like it was good for the company to bring in a new CEO, would you do that, or are you tied to the title?
Right.
Generally, we don't want to invest in founders that are doing it because of their ego or because they want to be CEO.
Yeah.
We want to invest in founders who want to build a big company and be a big success. And if they need to hire a CEO to do that, and they are still the largest shareholder, but if they need to hire somebody to help them, we want founders who will do what it takes to be successful. And so we test that actually during the diligence process and ask them, like, what are you really good at? What can you use help with? And so most of our founders remain founder and CEO, but we want them to be open to sort of rearranging the team if needed.
If that's what's best for the company.
Right. At some stage of the company, maybe a 10 million revenue, might be 100 million revenue.
Do you have anything else, any other hot takes you'd like to, any wisdom you'd like to drop on us and our audience?
Good question. I think we've covered most of it. Most of the things. I mean, I think the one other thing that I've been talking a lot about, like at events and conferences, but I do think in-person interaction is really important, especially in this age of AI and web and mobile and Zoom and everybody, post-pandemic. I think, and we've been, encouraging our companies to do more in-person, like industry events, and they're really good for sales because you're just different than the company trying to sell on Zoom versus you're there in person. You're sponsoring a happy hour or dinner or lunch or the conference, and in some industries, it's critical to do that. But also for fundraising, it's really interesting. I go to a number of sort of venture kind of events. And I always encourage founders to think about that interaction. It's an interpersonal interaction. And I always, one, do the work up front to schedule meetings when you go in person.
Yes.
Because showing up to the event and trying to chase people in the hallway is really hard.
Yes.
But also think about, like, if it's 7 p.m. in the evening and it's like, a happy hour reception, and I as an investor have been taking meetings for 10 hours. Like, you can come up to me, give me your business card and say, I'd love to talk to you tomorrow, but don't try to pitch somebody a 15-minute pitch, standing, at the bar. Like, really think about the interpersonal reactions and think about fundraising as sales. The same way you would treat customers, investors are ultimately customers. They're buying your shares, they're buying into your vision, your company, and think about it as a relationship. There might be a 5 or 10 year relationship, and sort of the courting period is 2 or 3 months. And so everything you do in that 2 to 3 months, from the first time you meet an investor till they wire the money, is essentially part of the diligence. And anything you do in that is part of that. So I always encourage founders to think about that.
In real life feels like, I think it's always been important, but it feels even more important. And I have interviewed a founder who I'm seeing again, who just raised their seed, a big seed on Monday, and he flies to every single customer when they're closing. And we just did, my partner and I, we just did a little episode on Pop-Up Bagels, which is another founder who goes in person a lot of times. I just happen to be here. But it makes a huge difference.
It does. And we encourage sales teams and a lot of people to think about, how do you differentiate from your competition?
Showing up in person is just, in this day and age when everyone can be doing it on Zoom, is a differentiator.
And even on fundraising, particularly for folks who are in New York City, like every meeting, the founder should be asked to do in person. If the investors don't want to, that's fine. But I've had the experience where, we're in South Florida and I've invited founders like, I don't have the time to drive up to Fort Lauderdale, I'll do it on Zoom. And I'm like, that's probably a no, right? If you're trying to raise capital and you can't make a 30-minute drive, but in New York City, you walk across town, there's a lot of investors here. In person is really important, because that's where you can really sell and differentiate yourselves from the other 10 pitches that investor took that day.
But also, you're checking out these partners to see if you want to be their, I guess, their company for 5 to 10 years.
Exactly.
You've got to vet them as well.
Yep.
And you get to understand that better in person.
Yeah, and how, we ideally don't want to invest in a company where I'm going to dread going to board meetings for the next 5 years, right? Where founders just, don't listen, we don't click, we don't have the same vision of what they want to do with their company. Again, not right or wrong, but if the founder wants to do something that we just don't agree with or don't see eye to eye with, we'd rather figure that out before we invest than after.
Yeah, absolutely. Well, I think that's all I've got. So I really
Great.
appreciate you coming in.
Yeah, thank you. Again, thanks for having me.
Great. And I'm Helena Fogarty, and this was Inside the Fund.